Network. All right, Rick, let's talk about this chart for Nvidia. It's been quite the recovery since April, but what trends are you noticing?
It's been really straight up since that point in April. We're up about 82% from those lows when we had our tariff news that shook markets here. But you can see strongly outperforming not only the broader market, but also its own technology sector. Notice as well the very high level of correlation between Nvidia and the S&P 500. It's such a big part of this index here that they can have big effects. Nvidia can have big effects on the S&P. And also, notice if they do start to diverge at all, that would make it even more noteworthy. If we were to look at our chart here, we can see, just staying within the boundaries of our white channel here, our two trend lines, one going across the lows, duplicated it, and put it across the highs here. That's about where we topped out. RSI invalidated its downtrend as well and pushed into the overbought area. So, signs, it's what you would want to see if you're bullish in this name. No signs of divergence or anything.
Okay, so then what's the approach for an example trade, especially as you consider hitting record after record recently?
Right. So, if you are thinking continued upside, one trade you can consider would be an unbalanced call butterfly type of trade here. The example trade we put together, plus one, August 15th, 165, 175, 180, call butterfly at a $2 debit here. You can see that it gives us this shape here where we have our max profit. If it were to hit those two short strikes at the 175 level, $200 debit paid is the max loss. This is a risk-defined trade. And the advantage of this one over the conventional butterfly would be if you do get a runaway upside move such as, these big tech stocks can do, we have a level of profitability still here at the 180 level above that point. A normal butterfly would be, you would start to lose money if it would get above that point. The trade-off here is you pay more up front here for that extra level of security here. And, the risk profile here, the shaded area for this is for the July expiration. About August, we're within the area here where we would have that profitability area. So we would need a bigger than expected move, most likely to not, to take that lower level of profit here versus our $800 max profit potentially. So we can also see we would need about a 5.3% move to reach that break even of 167 here. So this would be a trade where you'd be hoping for the trend to continue. We see very high open interest at that August expiration around the 160 level, but also high activity between 170 to 190 here. So certainly not without, outside of the realm of possibilities.
Okay, all right. That's an example trade for Nvidia this morning. Thank you, Rick.
Nvidia insiders, who are usually senior executives whose remuneration packages include stock options and equity awards, sold a large portion of their Nvidia shares last month. Given that the AI industry has recovered greatly since plunging at the start of April, and that Nvidia's market capitalization is once again approaching $4.0 trillion, the insider sales are particularly notable. Nvidia's growth momentum is expected to continue unabated, and the company's CEO has guided for stock sales, so I don't think investors should read too much into recent insider transactions, despite the headline-grabbing news. More significantly, I continue to add at record highs because I think the market, strangely, still greatly underestimates Nvidia's potential for free cash flow growth in relation to the release of Blackwell, Rubin, and Rubin Ultra GPUs. Nvidia now accounts up a whopping 30% of my portfolio, and I think the AI GPU manufacturer is the only one in town in terms of FCF growth. In my previous essay, Don't Worry About Margins, I made a wise investment in Nvidia shares for a number of reasons. Although the transitory effects of tariffs caused Nvidia's gross margin to drop in the most recent quarter, the company predicted that GAAP and non-GAAP margins will increase by the year's end. Furthermore, I think the company might sell up to about 5 million Blackwell GPUs in the current fiscal year, as Blackwell deliveries are expected to gradually ramp up during the year. I think investors would prefer to concentrate on Nvidia's product portfolio and increasing FCF profitability rather than the recent insider sales, because free cash flows are also expected to ramp up extremely quickly over the next few years due to an acceleration in data center capital expenditures. News sites jumped on claims that Nvidia executives, including CEO Jensen Huang, recently sold off around $500 million worth of their shares last month. Insiders selling stock is attention-grabbing news, so I wasn't surprised at all. In the past year, insider sales totaled roughly $1.0 billion, which is a small portion of Nvidia's $3.85 trillion market capitalization. The announcement of Nvidia's insider stock sales coincides with the company's shares recently hitting a new high of roughly $158 per share. But as usual, context is important. Although Wang, the CEO, sold the most Nvidia stock in June, he did so as part of a predetermined $865 million plan. Last week, the CEO of Nvidia initiated the first stock sales in two significant deals that generated $14.5 million in revenue. In the near future, investors should anticipate higher stock sales since they are a component of a so-called predetermined Rule 10b5-1 trading plan. Even if insider sales are newsworthy, I think investors should not be swayed by them and instead choose to concentrate on the company's long-term free cash flow prospects. My unrestrained excitement in Nvidia stems from the fact that the GPU manufacturer is experiencing a sharp increase in free cash flow that has the potential to last for many years. Investors have yet to witness Nvidia's full potential for free cash flow, despite the company's excellent free cash flow ramp thus far. As I mentioned in my previous writing on the GPU firm, Nvidia produced $26.1 billion in free cash flow in the most recent quarter, which suggests that the chipmaker may be on course to surpass $100.0 billion in free cash flow this fiscal year. Current market estimates suggest a free cash flow margin of about 50% based on a projected $200.0 billion in total revenue volume this year. Thanks to the best-selling Blackwell GPU, Nvidia's free cash flow margin in Q1 of this year was 59% in Q1 of this year and 47% on a trailing 12-month basis. As a result, the market continues to anticipate an improvement in FCF margin this year. In terms of free cash flow strength, Nvidia surpassed Apple, the once dominant tech giant, in the most recent quarter. Apple is one of the Magnificent Seven Group's strongest companies. In Q1 26, Nvidia's free cash flow, FCF, jumped 170% above its quarterly average over the previous 3 years, making the chipmaker the firm with the greatest FCF and the most significant free cash flow momentum. So, what implications does this have for Nvidia's stock? Let's explore that. But first, a big thank you to those of you who've stuck with us this far. Creating these videos takes significant effort and dedication, so if you're enjoying the content, please hit the like button, subscribe to our channel, and share your thoughts on Nvidia stock in the comments. Your support truly helps us grow. Now, let's get back to the video. The primary reason why Nvidia should be able to maintain this free cash flow momentum throughout the second half of the year and beyond is that Capex momentum is also picking up speed. This is due to several factors, including the growing power of applications of AI. AI startups have grown significantly and are now able to raise significant sums of money from investors. The anticipated appearance of data centers with millions of GPUs, sovereign AI, and the emergence of AI factories, end-to-end systems that oversee the full AI lifecycle, reflect the growing need for nations to create their own national AI strategies in order to modernize their IT and business infrastructures and get ready for the AI era. These factors all point to a huge supercycle of AI spending that may continue for many years to come. As a result, Capex expectations are also beginning to soar. Nvidia is undoubtedly the market leader in GPUs, but the company still has a lot more potential than is often recognized. With data center-related capital expenditures expected to reach 1.0 Ts by 2028, Nvidia will have a unique opportunity to accelerate the growth of its free cash flow. Given that data center capital expenditures are expected to increase rather than decrease in the upcoming years, Nvidia should be able to maintain its present free cash flow margin and possibly even boost its top-line growth. Nvidia's top line is predicted to reach $322.8 billion by 2030, which, in my opinion, understates the company's potential. The estimate suggests a very modest average top-line growth rate of 13% annually, which seems incredibly low, considering the strength of the projected multi-year runway in estimated AI-led Capex spend. Given the intense demand for AI GPUs, I am much more confident that Nvidia will be able to maintain its growth momentum in its core market, and believe that an average annual growth rate of 25% for the top line is much more achievable. For instance, Nvidia has already sold over 3 million Blackwell GPUs this year, and, at its current rate of growth, could likely sell 5 million by the end of the year. The chipmaker may increase its sales to over $500 billion by the end of the decade, or $488.3 billion, if it increases its top line at an average yearly pace of about 25% over the next 5 years. The AI GPU manufacturer might reach 245.0 billion in free cash flow by the end of the decade, on an annual basis, if it can sustain a free cash flow margin of 50%, which is 9 pp lower than Nvidia's Q1 26 margins in the face of growing competition, primarily from advanced micro devices. Given the anticipated increase in Capex and FCF in the data center market, Nvidia's shares are still essentially a steal from a valuation perspective. Furthermore, the valuation is not indicative of the actual free cash flow potential that Nvidia is creating with the release of Blackwell chips and Rubin in 2026 and Rubin Ultra in 2027. At a price-to-earnings ratio of 27.4x, Nvidia's shares are currently worth about 2% more than the GPU manufacturer's average valuation over the past 12 months. AMD is currently priced at a 25.2x forward earnings, which, in my opinion, also drastically undervalues the chipmaker's potential. AMD is increasing its product development in the GPU and AI accelerator space. I find Nvidia's value multiplier to be unsuitable for several reasons, including, first, Nvidia is getting better at converting revenue growth into higher margins and free cash flow growth. This implies that Nvidia keeps a larger portion of its free cash flow for each dollar of revenue. Number two, Nvidia's FCF prospects and visibility are further improved by a larger product pipeline in terms of GPU development and advancements in terms of ramping up Blackwell GPU deliveries. Number three, as transitory tariff effects are lessened, Nvidia has forecast a sizable GAAP and non-GAAP margin rebound in the second half of the year, which should help allay concerns about the company's margin trajectory. Number four, the data center market's capital expenditures are increasing rather than decreasing. Consequently, Nvidia's revenue and free cash flow prospects may still be significantly undervalued by the market. As a result, I still believe that Nvidia has significant value upside in terms of both multiple expansion and actual earnings forecasts, which, incidentally, have been rising since the company's Q1 26 earnings were released. In my view, Nvidia's high margins and massive FCF profitability would allow it to trade at about 30 times FY 2030 free cash flow. By the end of the decade, Nvidia's market capitalization might reach $7.35 trillion, based on my forecast of $245 billion in annual free cash flow by FY 2030. This suggests that Nvidia's stock has a 91% upside revaluation potential and a fair value of about $300 per share. As a result, I anticipate that Nvidia's stock will at least double in value by the end of the decade, but any quickening of the company's growth could result in a significantly higher intrinsic value for the manufacturer of AI GPUs. In my opinion, Nvidia's greatest risk is a possible slowdown in GPU expenditures from hyperscalers and data centers. However, I think this is unlikely to occur because businesses across all industries are eager to advance their AI capabilities. My perception of Nvidia might shift if the chipmaker had a sharp decline in its profitability profile, particularly in terms of free cash flows, or if AMD suddenly gained significant market share in the data center sector. Although Nvidia is concentrating on its Blackwell ramp, the firm is heading toward a one-year product release cycle and has a full product pipeline. This means that every new release of Nvidia's newest data center GPU is ready for widespread acceptance by the rapidly growing data center sector. The AI market is expected to grow far faster than investors anticipate, which is why I think the Capex ramp mentioned here is so underappreciated in the current market. Data centers will seize the chance to acquire the newest AI chips in order to fully utilize the improvements in AI, which generates a fresh trigger for an upward repricing. Next year, Nvidia's Rubin GPU will be released. I have never had more faith in Nvidia because I believe the chipmaker is poised for a significant acceleration of free cash flow growth over the coming 3 to 5 years. As a result, I now own 30% of Nvidia, making it my largest portfolio holding. Whether insiders are selling or not has no bearing whatsoever on my sentiments regarding the chipmaker. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.